Hello, welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Markets. Now today's topic is assessing the winners and the losers. So from an investments perspective, I think the coronavirus is, as I deem it, really started on February 22nd. All right, now we're at the end of the quarter. And it gives us a chance to catch our breath a little bit and look back and see to assess the winners and the losers. Now, before we get there, I want to talk about initial claims. Every Thursday in the U.S., the Department of Labor produces the initial claims. These are people that are applying for first-time unemployment benefits, unemployment insurance. Now, historically, for the better part of the last 5 years, that number on a weekly basis has been between 2 and 300,000. Right? So in a population of, say, 330 million people, 200,000 people, again, it's very bad for them. It's a difficult time, but it's a very small percentage of the population. Right? So historically, we had about 200,000 people unemployed per week. Last week, the print was 3.3 million. So we went from 200,000 to 3.3 million. Wow. That's a lot of laid off people in a week. But what I cautioned you last week when we talked about this, you remember, is the state of New York really wasn't in that 3.3 number, the 3.3 million layoffs. You say, what do you mean it wasn't in there? Well, the state of New York only had like 20,000 layoffs. It was obviously in there. But the layoffs in the state of New York, where the coronavirus is hitting most enthusiastically, or the strongest effects, really weren't showing up. So I cautioned you then that 3.3 million number was low, probably artificially low. Well, the number this week that we just received this morning was 6.7 million. Remember, that's a 1 week number. 1 week number. So we had 3.3 and 6.7. We're not double counting them, right? That's not a cumulative number. We have to add these two together. So in the last 2 weeks, we've had 10 million people laid off. Wow. Then now that is something to think about. 10 million people. The demand destruction associated with those layoffs. Obviously, shortly after people are laid off, they're going to run out of health insurance and so forth. The second and third order effects of this are something to consider. But we'll get back to that. That'll be a topic for another day. Let's get back to winners and losers, right? We're at the end of the quarter. Who are the winners and losers? Most of you are going to be terribly surprised by this. This chart really makes me scratch my head. Let's go to the chart here. The big winner was tech. The top performing sector in the S&P 500 for the first quarter was tech. What the hell? We're in a healthcare crisis. How was it that tech outperformed healthcare? That seems remarkable by itself. You add to that, tech is generally considered to be one, if not the most cyclically sensitive sector. Historically, it's been the most cyclically sensitive. It's the high beta sector. It's the high risk sector. So when things are going down, historically you would have expected tech to outperform. But not only did it perform, it held in better than anything else, including healthcare in the middle of a healthcare crisis. If you didn't hear me the first 3 times. Why is that? Well, I think it's due to 3 reasons. Their ability to generate free cash flow, the strength of their balance sheets, and their lack of leverage. Right? The small debt levels. So, tech, the way we thought about it historically, is not tech today. Tech is playing the role of a defensive sector right now. Just amazing. All right, so we have tech and healthcare here as our first two. One down 12%, the other one down about 13%. Now, alongside that are the sectors you'd probably expect to be at the top of the list or near the top of the list. Right? The safe sectors. Consumer staples, right? Our consumer non-cyclicals, utilities. These sectors have the most bond-like or the most fixed income-like characteristics to them. Next in line is consumer services. Consumer services, right? So this is what used to be just considered the telecom sector. Sorry about that, I haven't updated this yet. But it's the old telecom, right? It's the Verizon, AT&T, T-Mobiles of the world. Plus, they moved some groups out of tech. So now communication services includes telecom and electronic entertainment, or electronic media, I think they call it. All right, so the Googles, Facebooks, Twitters, Netflix, Disney's, they've all been moved down here. All right. A lot of these firms used to be in tech, and now they moved down here to telecom. So to me, again, this is a tech-like index. Real estate being one of the defensives, right? It goes with utilities and staples. That's not surprising. Consumer discretionary. That's a little hard to believe. Consumer discretionary actually outperformed the entire S&P 500. It was only slight, but how in the world did that happen? Right? What's in consumer discretionary? You think of it, and it's the restaurants, right? All the restaurants, the McDonald's of the world are in there, right? Well, who the hell's going out to eat right now? You'd think those firms would be under a lot of pressure, or at least underperforming the market in general. So you got the restaurants, you got the building materials companies, right? Home Depot and Lowe's are in there. You got the car company. Who's buying cars right now? So why is consumer discretionary holding in? Well, the biggest firm in consumer discretionary is Amazon, right? Another tech-like company, but it's not in the tech bucket. So that's what I believe is going on here. Now, the underperformers, again, down here, energy being the biggest underperformer. The other one I want to highlight, though, is financials. If you're going to try to catch a falling knife, financials is something I think you should think about. The financial sector largely has three main areas to it. Right? It has the banks, the asset managers, and the insurance companies. And I think what's going on here is people are thinking about financials incorrectly. They're thinking about them from a historical standpoint. And just like tech is being thought of, or the way tech used to behave as highly sensitive, cyclically sensitive, it's not today. The same is true about financials. Financials today are not what they were before. Financials have solid balance sheets. This isn't like 2008 where the bank balance sheets were in question. So I'm a little hard pressed to figure out why financials are underperforming. I understand the net interest margin concept. Net interest margin is they take in deposits on a short term, right? They pay short term interest rates and they invest long term. Generally mortgages, right? So if you have a flat yield curve, that means a bank's profit margin goes down. I understand that, right? But still, the yield curve has since increased, right? So originally during the crisis, the yield curve was flattening, but since then it's actually gone back up. So that should actually be a plus for financials. And also the fact, the quality of their balance sheet. So if you're going to catch a falling knife, financials would probably be the way or the place I'd suggest you look. So I would continue with tech, right? Tech has the magic formula right now, the pristine balance sheets. And of course you have the normal defensive sectors, utilities, staples, real estate. And then financials might be the other place I'd think about looking. All right, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.